So we're recording, and this is the study guide for quiz 6. And the first one here, I don't even need to, I mean, I've actually given you the definition, so this is all you need. And I put this in here because in order for me to give you only the questions like you're going to get asked on the AP exam, I have to do some review and some jump a little bit ahead, because there just isn't enough actual questions that are going to be on the AP exam on any one topic. So most of the ones on here are on the topic of balance of trade. But the way your book is in the chapter that you're doing, which is the chapter, I think it's chapter 11. Let me just check real quick. Chapter 11, yeah. They only talk, they only tell you half of the story, and you really have a hard time talking about balance of trade without talking about the foreign currency exchange markets. So I had to put that in there, and that's sort of jumping ahead. But so we're going to really talk a lot more about that when we get to near the end. So the book is the book, and without jumping around crazily, I'm trying to do the book pretty much in the order of the book. But then that requires me to jump ahead some in your quizzes, but I think it'll be fine. So it's just hard to match it up exactly. So I wanted to kind of explain to you why you're going to get some quiz questions that aren't in chapter 11, which is why I'll make sure that you understand it through this study guide. Okay, good. So crowding out is just simply the idea that when the government goes into a budget deficit, they typically borrow money to make up for the deficit. So a deficit just simply means that when you look at the balance of trade, this right here, a deficit just simply means that G is greater than T, right? The government spending is more than we actually take in for taxes. So typically when that happens, the government has to borrow. And when the government borrows, that drives up money demand, which drives up the cost of money. See, think of money as a commodity, just like cookies or anything that you buy, right? It's just something that you buy. So when you buy money, the rental rate of money is the interest rate. So when demand of money goes up because the government's demanding more money to pay for its deficit spending, then the interest rates are going to go up, which makes it harder for private companies to invest. Because remember, when we talk about domestic investment, we're talking about private firms wanting to do some type of a project, and they borrow the money to do it. So they want low interest rates, okay? When we talk about foreign investment, that is totally different. That's foreigners wanting to invest in, say, a government treasury bonds, and they want to make money on their investment, so they want the interest rates to be high. So if I'm going to say, a simple way to think about that is, if I want to keep money in my savings account, I want the interest rate that my savings account is paying to be high. That helps me, right, if I'm saving money. If I want to borrow money in order to invest in in expanding my house, I want the interest rates to be low, okay? So don't get confused about those two very different types of investments, okay? Very different. One, you want the interest rates low, and that's domestic investment, because it means renting money to invest in something you want to do with your company is less expensive. But if you want to buy debt, if you want to actually use your money to lend to someone, because that's what's actually happening when foreign investors come in and buy treasury bonds, they're actually lending money to the government, and then they want to get a return, and so they want the interest on their bonds to be as high as possible. Okay, so let's see. Understand the relationship between real interest rates in a country relative to the world real interest rates, and a capital flow and relative exchange rates. Okay, so when the interest rates in a country are higher, that's going to attract foreign investors. Okay, so that will create what's called a capital inflow into the U.S., and that's going to mean the demand for U.S. dollars goes up. Now, if the demand for dollars goes up, that means that foreigners are actually buying dollars with their currency. So that means that the value, since the demand for dollars is going up, that drives up the value of the dollar. So if you look at, if I can find one here, just real quick, if you look at the foreign exchange market, whatever is on the horizontal axis is what we are actually talking about in terms of buying and selling in the supply and demand. So here we're buying and selling dollars, and we're in this case right here, we're buying dollars with South Korean wons, right? So when the demand for dollars goes up, it means that the price of wons per dollar goes up. So dollars become more expensive relative to wons. So the dollar appreciates relative to, in this case, the South Korean won, okay, when the demand for the dollar goes up. So whenever you see a foreign currency market graph, whatever currency is on the horizontal axis or the x-axis is what is being demanded and supplied in the graph. The other currency is going to be in the denominator of the exchange rate, right? So won per a dollar, euro per dollar, peso per dollar, whatever it is. Okay? Does that make sense? Head shaking? Yes. Okay, good. Okay. Okay. Okay, this one, I was actually surprised this one was even in the macroeconomics, and I was getting all, because it's kind of more of a microeconomic thing, but this is sort of big picture. Okay, so if labor productivity goes up, okay, so typically in the macro, if you think about macro, that is typically because of some kind of more advanced technology. So what that means in the macro, let me see if I can find a graph here that will make it easier to see. Yeah, here we go. In the macro, when labor becomes more productive, it usually means that some kind of technology has been developed that makes workers more efficient, able to do more with less. So that's going to shift the short-run aggregate supply curve to the right. Okay, because if it's more productive, it means that, if you think about it, if I can produce one widget in an hour, then that a widget cost 1 hour of my labor. If I get a machine that enables me to produce 2 widgets in an hour, now they're still paying me the same amount for that hour, but I'm producing 2 widgets. So now the cost of the widget just cut in half because I produce more in the same time. That's why the cost goes down, okay? And the other thing that happens is the long run or the potential, if all the workers in a society become more productive, it means potentially the economy can produce more. So it also shifts the long run aggregate supply curve to the right. And it would also expand, if you think back to your production possibilities frontier, that concave shape curve, it would shift that out to the right as well, okay? If all the workers became more productive, because that creates more potential for production. Okay, does that make sense? Okay. So what would happen then, where were we here? Right here. So what would happen is that you've got a shift in the short run and the long run aggregate supply. And then if prices are flexible and things can change, then that's going to lower price levels and increase output. Okay. Now, it's also going to, now think about this. So we're going to be in a situation where we go from P1 to P2, lower price levels, Y1 to Y2, increased output. Now, real income or real wages go up because if overall prices go down, that means you can buy more with the money that you have. So even though you might not have any more nominal money, I mean, you might have the same amount of dollars. If those dollars can now buy more because everything costs less, it means you have more buying power and your real wages or your real income actually goes up. Does that make sense, guys? Okay. So that's the relationship. You know, this is a bunch of, you know what this really is a bunch of cause and effect relationships. You know, this causes that, right? And it's also important just to sort of, you know, understand the relationship here, that real income is calculated by dividing nominal income by the price level, okay? So if you think about a fraction with the nominal income in the numerator and the price level in the denominator, if the denominator gets smaller, then the whole expression gets bigger. So the whole expression is your real income. So if price level goes down and the numerator, the nominal income doesn't change at all, well, the whole expression, the whole fraction gets larger, right? That's just, you know, 4th or 5th grade math or something, right? When the denominator of a fraction gets smaller, the fraction gets sorry, I said it backwards. Yeah, gets bigger, right? When it gets smaller, it gets big. Yeah, because 1/4 is larger than 1/10. Yeah. Okay. I'm confusing myself here. Let's see. Where are we? Okay. Okay. This is very simple. If everybody in the U.S. starts to get more money, if their income goes up, in the macro sense, there's going to be more dollars supplied in the world, okay? So when U.S. consumers have more disposable income, more income they can do whatever they want to with, the supply of dollars in the macro sense, that does not mean that, you know, that the typical American consumer is going to go out and put money into the foreign exchange market. But in the macro sense, if overall household incomes in the U.S. go up, the supply of dollars in the foreign exchange market goes up, right? And if we go back to our graph here, we can see if we increase supply in a typical graph, and we can think about this as now being euros, right? If we increase supply, get this guy right here, I guess, then the value of the dollar goes down, right? So when demand goes up, the dollar appreciates. When supply goes up, it's a shift to the right, the dollar depreciates. Okay, and that's why what I do even now is I sketch the graph, because if I don't, I get it half the time. I'll get it backwards, right? If I sketch the graph, there's a lot more of a chance I'll think correctly. Excuse me. Okay, where were we? I think I might have skipped one. Oh yeah, I skipped this one right here. So a budget deficits and real interest rates, okay? So when the government budget deficit decreases, that means that we've got this expression right here. Let me get back to it. Oops, this one right here. If the budget deficit decreases, it means this right here gets smaller, okay? Because it means taxes are either going up or government spending is going down. This whole expression, G minus T, gets smaller. And if we write it like this right here, this would get larger, okay? Anyway, but the point is that if the deficit gets smaller, the government is, let's just say it got smaller because they charge more taxes. That means they have to borrow less. That's the point. If the deficit gets smaller, the government has to borrow less. And if they borrow less, money demand goes down, which means that real interest rates go down. Okay, that's what that means. Okay, and once again, if you just think about, what are deficits, deficits mean the government needs to borrow money, right? So the higher the budget deficit is, the more the government is going to borrow and crowd out everyone else, driving the interest rates up. Okay. Now, went over that one already, right? Current foreign currencies. Yeah. Now, this is something you can just look up, but it's very, very simple. It's when you get both inflation and higher unemployment, right? So if you think about the Phillips curve and the aggregate supply and demand curve, if I've got it in here somewhere, I hope I do. Yeah. What's going to happen is, let me jump back over here. So I think I have it over here. No, I don't. Wait a second. Got it in here somewhere. Maybe I got it here. No, anyway, I just jump back. Okay, okay, it doesn't matter. What's going to happen is, sorry. I want to show. Okay, so, okay. The short run aggregate supply shifts to the left. That's stagflation. So you end up with a situation where you have not only higher prices, right? If we're going from, say, here to this point right here up to there, you've got higher prices, which is inflation, and lower output. Okay, so that's going to look like on the Phillips curve. You're going to have both higher inflation and a lower output, which I think means you're going to have a shift. But let's just look at it. then think about it. So if we just move along the line here, you get higher inflation, but you also get lower unemployment, which is not what happens with stagflation. Stagflation means you get both higher inflation and higher unemployment. And the only way that that's going to happen is if this whole curve shifts, okay, up that way. Okay. Anyway, so you can also just look it up. This is just a simple simple definition that you can, and there's also a good video about stagflation. Okay, now this one right here is a review. It's a little bit tricky, and I wanted to sort of, because they're asking you to look at the real exchange ratio. Okay, so without actually giving the question away, how many more do we have here? It's a long one. Okay, let me hurry up a little bit. Without actually giving this away, I just want to give you kind of a hint here, if I could find one. I got here somewhere. I might have to go through here a while. Okay. Nope, I want the actual. Oh, come on. This guy. Okay. Let's see if I got any more in here. That's it. I wanted to find, maybe I can't find it. Okay, here's the one I want. Okay. What you need to do is look at what, and this isn't the one for the quiz, but it's like this, okay? If we think about this, if Luna doesn't trade at all with Ashna, 1 ton of food costs 1 ton of machines, okay? So it's 1 to 1. And if Ashna doesn't trade at all with Luna, 3 tons of food costs 1/3 of a ton of machines, or 1 machine costs 3 tons of food if they just don't trade at all, okay? That's their opportunity cost. Now, when you answer the question, you're going to want to look at the answer where both countries get a better ratio from a trade. So if we're looking at this one right here, you'd want Luna to be able to get 1 machine for less than 1 ton of food. So like if it was 1 machine only cost 1/2 of a ton, they would be better off. And you want Ashna to, and you want to find the answer because what would make these two countries want to trade is if they could trade and get whatever they are selling for a cheaper, okay? So in this case right here, Ashna is better at producing food, so they're going to sell food for machines. So 1 machine is going to cost them, if they just don't trade at all, if they just stay in their own country, 1 machine is going to cost them 3 tons of food. So you want to find the answer where 1 machine costs something less than 3, and where 1 ton of food costs them something less than 1. And so find the ratio where both are better off than they are if they don't trade at all. Okay? Does that make sense? That's what you're going to look for when they say a ratio. Okay? The ratio here is 1 to 1, and the ratio here is 3 to 1. Okay? You want something better than, you want something like 2 to 1, right? Because they're going to sell what they're good at. They're going to export food for machines. Okay, I think this is Ashna, right? Ashna has in the food because they do they do more food than they, yeah. Okay, so that's that one. And I think you'll be fine with that. It's just a review, but the question is just worded a little bit differently. Okay, this is the same thing as before. If a labor productivity increases, then the marginal cost of a production goes down. So that means that it costs producers less to produce the same output. Okay, so it's going to shift the short run aggregate supply curve to the right if the labor productivity increases, and that's kind of very similar to the one up there. So I won't spend any more time on that one. Okay. Now, if in one country, if like let's just say in the U.S., if the U.S. is going through an overall price levels that are getting higher or that are increasing, is going to mean that it costs foreigners more to buy our goods. So that means that we'll end up buying more foreign goods. So what we're really saying here is that if relative to say, I don't know, China, we have a higher inflation rate, then we're going to export less to China and import more from China, because relative to the prices of our goods, their goods are cheaper. So whichever a country has the highest inflation rate, that a country is going to export less and import more. She just makes common sense. Okay. Now this one right here, I kind of touched on this before, but it's a little bit tricky. Because we're looking at two different graphs that have different variables. Okay. So when the aggregate demand curve shifts to the right, that means that unemployment goes down, okay, because we're employing more workers. And the reason I say it like this is because the variable on the Phillips curve is not employment. The variable on the horizontal axis of the Phillips curve is unemployment, okay? And then the variable on the Phillips curve on the vertical axis is the inflation rate, okay? So what's going to happen then is if we have a shift to the right, so I'm going to just jump back over here really quick and I'll show you. See if I can get there a little bit quicker if I go like this. Find the graph. Wrong graph. Okay. Yay. Okay. So if this shifts this way, okay, then you're going to get higher price levels. And when we get more output, that means we employ more workers, which means unemployment goes down and inflation, a price level, goes up. So what this shift on the aggregate demand and supply curve looks like on the Phillips curve is a movement from A to B, okay? Because when we go from here to here, in terms of real output, we gain workers, which means unemployment goes down. So we shift from here to here because we're lowering unemployment and raising inflation. Okay, so from here to here, a movement from here to here is a shift up here from here to here. Okay. So that's because they're different graphs. It's important to know the relationships of those two graphs. Okay, so if we have corporate taxes going up, it means that for companies, their production is going to get more expensive. And that's going to shift the aggregate supply curve to the left. Okay, which means that firms are less likely to invest in new projects because the taxes are going to lower their profits. So this is going to affect aggregate demand. So that means that aggregate demand is also going to shift to the left. And understand that when we think about national income, that is the same thing as national expenditures. So when we look at the aggregate demand supply curve, this represents both total expenditures and total income. So when this shifts this way, right, and this shifts that way, our national income goes down, because whatever is spent is also someone else's income, right? Somebody else has to get it. So we can think of Y here as either being total expenditures or total income, either one. Okay, which is why that you can see that when we have a shift in the supply and the demand, we're going to have a change in the national income. Okay, and if we have, okay, so that's that one. So just really quickly, if the business taxes go up, it's going to mean a shift to the left of both the aggregate supply and the aggregate demand, which is going to mean that national income goes down. Yep. Okay. This is very similar to one we had before. A budget, a deficit. So once again, when the government budget deficit goes down, the government borrows fewer dollars, which means that the demand for the dollar is going to go down, which means that capital inflows will go down. Now this is a little bit trickier. Okay. No, what you want to think about it is that when the interest rates go down because the government's borrowing less, it means that foreigners are going to want to invest less because they're not going to get as much return on their investment. So foreign capital coming into the country will decrease, which is going to mean that if the capital inflows go down, that is going to directly affect our net exports. Okay, so whatever our imports, whatever a direction this goes in, is the same direction that the capital inflows go in. So whatever amount that we're buying, whatever the value is, the exact same value comes in as a capital investments. So if capital inflows drop, then imports go down. And since net exports are exports minus imports, then the expression for net exports goes up. Kind of confusing, but that's how it works. Okay. And then the other thing here is make sure you watch the video that I sent out. But the simple answer to this is, or the simple way to think about this is that whatever the difference between our imports and our exports is the current account deficit. Okay, so if our imports are greater than our exports, then we're going to be in deficit, and that's the current account. And whatever amount we're in deficit, we're going to be in a financial surplus, because whatever value of the stuff that we buy, whatever that money value is, when we spend that money, that exact same amount of money comes back in to the country as foreign investment. So a deficit in the current account, which is a difference between the imports and the exports, means there has to be a surplus in the financial account, because these two have to add up to be zero. Okay, so that's just something to keep in mind. Very important. Okay, and this is really simple here, because the trade deficit is a function of whatever, if net exports is a positive, because it's our exports minus our imports. So if that's positive, we are exporting more than we're importing, so we're in a trade surplus. If it's a negative, we're importing more than we're exporting, and that's a trade deficit. That's easy. Okay. And the way to think about this one is, the more expensive, the more value, the more valuable the U.S. dollar is to a foreign currency, the more our goods are going to cost. Because in order for China to buy our goods, they first have to buy dollar. They first have to exchange their currency for our dollars. So if our dollars cost them more when they exchange with their currency, they're going to buy less of our goods. So when the dollar appreciates relative to the currency of a trading partner, our exports to them is going to decrease, because it's just going to be more expensive. Okay, and this one right here, lowers the demand for money. So if the general overall price level in the economy goes down, okay, that's going to be, and let's just assume that's because the aggregate demand curve shifts left, okay, from here to here. So price levels are going to drop, okay? Output's going to drop, okay? That we know. And when there's less when prices are dropping, the demand for money is also going to drop. And if the demand for money drops, remember the cost of money is the interest rate. So if the demand curve for money shifts to the left, then that's going to lower interest rates. That's the let me just pull that up real quick here. So I've got it right. The money demand and the supply curve, okay, here we go, is right here, okay? So when this money demand shifts to the left, it's going to mean that the interest rate also drops. So that's all those variables, okay? So demand for money is lowered. So then that shifts the money demand curve, which is a downward sloping to the left, which lowers interest rates. Now, a tricky thing here is if the nominal interest rates here go down, it makes a domestic investment cheaper, because remember, domestic investment, which is the investment in this formula right here, in this expression here and here, that is going to go up if the cost of money goes down, because typically firms will borrow the money to invest. So we have a shift in the money demand curve here to the left, and the cost of money goes down. It's going to cause domestic investment to go up, because it makes borrowing money to invest in some kind of a project cheaper. Okay? I know that's a lot going on there, but it's important to know all those relationships. Okay? Okay. So this is simple. When our imports go up, when they increase, when we buy something, let's say we buy something from Germany, they sell their currency is euros. So in order for us to buy something from Germany, we first have to exchange or buy euros with our dollars. So when we import, it means capital inflows go up, because we are buying euros in order to buy their goods. Okay, so that means that the demand for a foreign currency goes up. Okay, so when we import more, we're going to demand more foreign currency. So these move in the same direction. Okay. Okay. Now this is that whole video. Okay. Stephanie, did you have a chance to watch that video that I added today?
I didn't get to watch it yet, but I'm gonna
that's
watch.
Fine. But I'm not going to. But this is what this is. This just is saying that what this is saying is simply that if on a personal level, right? If I buy more than my income, okay. So when we actually go into a trade deficit, it means that we're buying, or we are importing more than we're selling. So we actually have to borrow the money. So like if I were to buy something that costs more than what my income is, I would have to put it on my credit card. I would have to borrow it, right? Which means that in the macro sense, if I borrow money on my credit card, my credit balance or my financial account actually goes up, because I borrowed this money. Now, so so these move in the opposite direction. Whatever a deficit our current account is, or a financial account has the exact same amount as a surplus. Okay, because whatever we buy, that same amount of money that we used to buy, the foreigners take the money and invest it back into the U.S., which means a surplus to our financial account. Okay, and then you can read all this and watch the video, and you'll be very smart and educated on that. Okay. And this is simple. Okay. So when we when we demand more imported goods, that means that net exports decreases. Because once again, over and over again, I've said it, net exports is exports minus imports. So if imports go up, net exports goes down, which lowers our overall GDP, okay? And that's pretty simple. And the last thing is make sure you understand all the problems for assignment 6, and you won't have any problems with the quiz. Okay?
Yeah.
And wow, this took longer than I thought. And the only other thing I want to say while the video is running is that I have set this one up so you'll see your grade as soon as I grade it. And I'll try to grade it Monday morning, so you'll see your grade. But you won't see the actual results, all your answers, and all the correct answers until I've graded all of the students, which hopefully I'll do on Monday. Okay.
Okay.
And there might be one. I think Julia said she might be late, but that's fine. But as soon as I've graded all the quizzes, then you'll be able to see the answers that hopefully you'll get them all right, so you won't even have to look, okay? But you'll be able to go back into the quiz, okay?
Yeah.
And the only other thing, and then I'll let you go, is that I didn't put the explanations for the right answers in the quiz, because I think that if you take the quiz and you go back and you look at this study guide, you'll see that the explanations for every answer is right here. Okay. Mm-hmm. So it would just be redundant. So this study guide pretty much explains why all the right answers are going to be the right answers. Okay. Okay.
Thank you so much.
Thank you for hanging out with me on a Monday night and for almost a whole hour. So you did really, really great. Do you have any questions about any of this?
I think I get everything. Yeah.
Oh, well, it's a lot. It is a lot, but it's not. The thing is what I would do is just think about the graphs, because the graphs really show the relationships better than just the words. The words can get confusing. The words can be very confusing, but the graphs make it easier to see, for me anyway. Okay. All right. Well, good luck on the quiz. Have a great break. And I guess I'll see you guys again in the new year.
Okay. Thank you. Have a good night.
All right. Bye-bye.
Bye.